Let's check in with James McDonald of Hercules Investment for his thoughts on this wild ride. James, good to see you. Before we get into equities and that whole kit and caboodle, I've got to talk to you about oil. And what do you make of negative oil prices, first time in history? And are you playing in the oil space at all right now?
First, I want to say it's very important people recognize what's happening with oil is coming to other asset classes. The unbelievable deflationary situation that we've been in with this virus crisis, this is just the beginning. And there have been a lot of speculators that have watched oil come down over the last couple of months. And as it goes to lower and lower legs, they want to buy in. If you just look at the largest oil ETF, USO, just 4 weeks ago, it was at double the price, which at that point was almost an all-time low. And it's important to understand that what's happening in this sector is coming to other asset classes as well, particularly equities. And I want this to be a warning for people that we are in unprecedented times, and it's a very, very dangerous market for people that don't have a short bias.
Having said all of that, are you exposed at all to the energy sector, and if so, in what way?
What we're looking at, eventually things will get better, eventually things will recover, and there are some extraordinary dividend values in the MLP space. And we are looking at names that are under liquidation right now, but obviously when there's a liquidation, there's a steep discount, and there are assets that are going to be around 12, 16 months from now that are at 29, 39 cents on the dollar. We're looking at these MLP holdings very carefully, looking at these bankruptcy proceedings, looking at these liquidations. We're going to find some great values there, not directly in oil per se, but definitely in the energy space.
You brought up bankruptcies, which makes me think about the retail sector. Neiman Marcus saying that it is going to be filing for bankruptcy. Late last night, Lord & Taylor said it is now exploring bankruptcy. We have to think we're going to come out of this pandemic with a much smaller retail footprint. Talk to me about how you see retail right now and where are the opportunities, James?
Well, opportunities, wow, that's a tough question, Alexis. We're just at the beginning phases. Really, this whole problem with the markets, we see it as in three phases. We see it first as the deleveraging and the defaults from the initial shock. Then we see the potential realization of economic data that's happening now and over the next months. But then the third phase is going to be the default of consumers and small businesses. And what that means right now for retail is you think things hurt now, wait till 6, 12 months from now. Things are not going to be good. We're going to see what we've seen in other crisis situations. We're going to see consolidations. We're going to see innovation. This is a destructive process where only the strong will survive. But we think that there will be many new entrants. As far as opportunities, right now, we've got to stay away from buying any of these equities because they're headed south.
All right, let's get a quick check of the markets here with Jared Blickery. What have you got, Jared?
All right, we got a Dow futures down about 475 points, as you can see, or 2%. S&P 500 down about 1.5%. And NASDAQ futures off about 0.7% off the least. Again, anything oil-related getting whacked right now. And we can just take another look at crude prices. This is going to be June, not May, which is going off the board and negative right now. But this is off 26%, just an astounding amount. Even Brent is now trading below $20 and doesn't have exposure to many of the problems or idiosyncratic factors we have here, Alexis.
All right, thanks, Jared. And we're going to pause for the opening call at the New York Stock Exchange. New trading day underway on Wall Street. Going to be an ugly open here as the equity markets react to this crazy action we're seeing in the oil markets, where oil actually turned negative amidst this pandemic, as the market is now awash with oil, and we simply have no place to store it at the moment. Also, Treasury yields adding to the slide as pressure on crude markets intensifies. We are joined this morning by James McDonald of Hercules Investment. Of course, we've also got Jared Blickery and Brian Sozzi with us as usual. So, James, where do you see the market going from here? Because up until the past couple of days, I'm going to say there's been this disconnect between the news of the day and how the market was reacting.
I've been studying this very closely, and I'm fascinated by the idea of central banks around the world buying securities to keep the markets propped up. Nonetheless, that's going to come much later. What's going to happen right now is we're going to see the digestion of reality in terms of economic data, both employment, earnings, and every other metric where stock valuations are placed. We're currently around a 21 PE average on the S&P 500. Over 36% of companies that have announced earnings so far have come in under. we see that is an imminent decline of at least 30% just based on pure line pricing. If there was no virus, if there was no catastrophic effect on a suspension of all commerce around the country, we still would come down to these levels because we are at the tipping point of a long historic bull market that had to come to an end. A normal retracement from that type of a bull market still gets us back down to the 2100 level on the S&P 500. And so what I see coming over the next several weeks and several months is reality setting in with the new economic forecasts that are now economic realities. Every forecast that came in was did not fully reflect the damage. And then there's the risk of reinfection. There are second waves. And when someone gets sick and gets better, the amount of time that it takes for them to recover doesn't necessarily make them not susceptible to reinfection. So there are a lot of potentially dire scenarios that only bring down the forward-looking price. I would say, obviously stocks are forward-looking. There's opportunities right now where people can see a recovery ahead, but even those scenarios are starting to look very weak.
James, just the plunge in oil prices is absolutely remarkable. Do you think, what's the read there just from pure economic standpoint, not just in the U.S., but also in China? I mean, the Chinese economy in some places has opened back up for business, yet you continue to see this glut in oil.
Right. So there's a vacuum for demand. And frankly, that vacuum is not going to go away in the immediate future. But again, this is really what's possible when you have a completely disconnected market in a completely interrupted market. The oil sector is just a picture of what's to come. I think oil itself, it's a little bit different than equities in that, there's a lot of geopolitical issues going on with oil, but still it goes back to supply and demand, and there's a demand vacuum. And frankly, with the suspension of the economy, I see similar catastrophic, unprecedented, catastrophic drops in prices coming across a lot of asset classes. And we're studying oil in that it could be a precedent for a lot of these asset classes where we're putting capital to work.
Hey, James, last time you were here, you had a pretty aggressive downside target. A lot of people were saying we're going to test the lows. You thought at least that they were going to be exceeded to the downside. Do you still see this scenario unfolding? If so, what are your targets?
That's a great question. It's good to see you again. I envy your job. I wish I could look at data all day. What we're going to have is we're going to have a repricing based on two factors. The first factor is going to be the initial shock of the virus, and that took out the bull market, right? And when a bull market stops, a bear market begins, and a bear market onset after a record bull market has to get us back to the 2100 level on the S&P, and it has to get us back to the 17.5 level of the Dow before there's even a virus. Once we factor the virus in, as I said earlier, the initial print on earnings is coming out about a third of earnings have gone away. If we think PEO ratios are going to be consistent with the pricing after that initial pullback, that brings us down to Dow 15,000. If we get consumer defaults later in the year, like we believe will happen here, obviously people aren't able to go to work, and some of these introductions of the removal of the lockdown, unfortunately, they may be premature. And if we see reinfection rates, it's going to start all over again. And if people don't have paychecks, if people don't have income, frankly, the rest of the economy is going to suffer. And if you don't listen to me, but you listen to the experts like at the Fed, the Fed president of St. Louis thinks we're going to see 30% unemployment. The Fed president in Minnesota thinks that we're going to see similar dire situations. And this is the reality that we have to face. And so the target for the Dow has to stay, at 15,000. I think at that point, I might see the Fed come in, and if we see global banks coming around and investing trillions and trillions of dollars into equities, then that would hold the market up there. But at a minimum, 15,000 on the Dow, 1,600, 1,800 on the S&P.
James, these are mind-blowing numbers, and people who are watching this right now maybe feeling really scared. What's your advice to them? I mean, I know it's a very individual question. It depends on someone's time horizon. But are you thinking that given all this turmoil, people should just hold on to cash? Is there anywhere to hide, perhaps, outside U.S. equities during this tumultuous time?
Right. Well, if you have a manager that understands how to monetize volatility, it's a good thing, right? For example, what we're doing, we're profiting from these declines by buying put options and then taking advantage of volatility as we have all year, and we can make money for our clients. If you don't have an advisor or don't have the wherewithal to get an advisor who can monetize volatility and can make money in a short market, absolutely move to cash. There's no reason to lose money This rally that's happened over the last several weeks has got a lot of people confused. We've been trying to educate our investors and our prospects about these retracements that have happened. They happened in 2008. The retracement in 2008 went up to the 50% point from the initial pullback and then came off 50%. It happened in 87. It happened in 01. It happened in 74. It happened in 1929. We're about to see lower lows and absolutely move to cash unless you have an expert that can take advantage of falling prices and volatility like we can.
All right, James McDonald of Hercules Investment, always a pleasure. Thanks so much.
Thank you so much.